We've all been to Wendy's at least once. Last quarter, a lot of people stopped going, but the company made more money anyway. Total revenue was up 3.3%. That's the number Wendy's led with. And sales at US stores open at least a year were down 7.8%. So the company took in more money while the restaurants served fewer customers. Both of those are in the same report. How that happens is the whole story. It's not the reason they gave for it. So let's open the filing. The report came out in May. The quick read in the coverage and on the news was simple. Revenue grew. The headline numbers held. So the turnaround must be working. And that read isn't crazy. Revenue really did grow. But why it grew is where it turns. Those same store sales, down 7.8%. It's because, in the company's own words, a decrease in traffic partially offset by a higher average check. That means fewer people came in. The ones who did paid a little more, mostly because prices went up. So fewer guests, that's the core of it. So the restaurants rang up less from actual customers. Wendy's doesn't argue that point. It's right there in the document. That's the part the headline number hides. Revenue up top, fewer customers underneath, which leaves one obvious question. If there were fewer customers, where did the extra revenue come from? Let's start with the stores Wendy's runs itself. The ones on its own books, not the franchises. Profit those stores keep after paying for food and workers was 10.8%. A year earlier, it was 3.5 points higher. That's 3.5 cents of profit gone from every dollar of sales. And if we put a real number on it, say one store sells $1 million of food in a year, 3.5 points is $35,000 gone from a single store. But why the drop? Higher labor, pricier ingredients, and fewer people through the door. All three are listed in the filing. And fewer customers doesn't only cut sales, it hits profit a second way. Rent's the same whether 10 people walk in or 100. The lights cost the same, the crew still gets paid. Part of management's fix was cutting store hours during slow stretches. Fewer hours open means fewer people served. Connected. That squeeze shows up all the way down the report. Operating profit was $64.9 million, down from $83.1 million. Profit before taxes fell 37.8% to $34.2 million. The bottom line, net income dropped to $22.7 million from $39.2 million per share. That means 12 cents against 19. And remember, total revenue went up through all of that. Keep holding it. Now, companies love an adjusted number, the clean-up version that sets aside one-time costs. Wendy's adjusted profit measure, called EBITDA, still fell 10.6% to $111.3 million. So this isn't an accounting trick hiding a healthy quarter. Even on Wendy's friendliest math, profit shrank. That's the quarter the restaurants actually had. So here's the turn. Everything so far is what the restaurants did. Sold less, kept less. So how did total revenue still climb 3.3% on top of that? Because revenue for Wendy's, the company, isn't the same thing as burgers sold. The gap between those two is the whole move. Three things pushed revenue up, and all three are named in the filing. 1. Higher franchise fees, tied to a program where Wendy's reshuffles which stores belong to which owners. 2. More money flowing through its national ad fund, after local ad dollars got moved up to national. 3. Higher sales from company-owned stores, because Wendy's bought a batch of franchise locations back in late 2025. Read those three again. A fee program, ad money moved between columns, and buying stores it didn't own before. Look at what each one really is. A fee is Wendy's charging its own franchisees more. Moving ad money is the same dollars in a different column. And buying a store just shifts sales that already existed onto Wendy's books. None of those three is a customer. And then there is the line they didn't put in the headline. When a franchisee sells a burger, Wendy's takes a small cut of that sale, a royalty, a slice of every dollar rang up under its name. If real restaurants sell more, that line goes up. If they sell less, it goes down. It's the cleanest read on actual demand in the whole report. That line, the one tied directly to how much real restaurants sell, did the opposite of the top line. Franchise royalty revenue fell. Same filing. The engineered lines went up. The one line that tracks real restaurant sales went down. And still the top line rose. That's the tell. It's hard to read that as a business selling more. So, back to the question from the start, revenue up, restaurants emptier. How? Now you know. The growth came from the holding company, not from customers. But stores shuffled fees, moved ad dollars. The restaurants themselves served fewer people and earned Wendy's smaller cut. The corporate revenue went up, the business underneath it got smaller. Which brings us to the reason management actually gave. They pinned the traffic drop on severe weather and on cutting store hours. Weather in the first 3 months of the year. Here's the problem. Weather is one bad quarter. This isn't one quarter. Reported US same-store sales were already negative before this winter, down about 2.6% in late 2025. And the stock is down roughly 46% over the past year. Industry-wide, restaurant traffic has fallen in 14 of the last 15 months. That's not Wendy's weather, that's people eating out less everywhere. Weather can dent one cold month. It can't empty a year. A traffic slide that started before the cold front isn't a weather story. It looks more like a customer problem they'd rather call weather. Now, to be fair, and this part matters, this isn't a chain falling off a cliff. On the earnings call, Wendy's said the monthly numbers got better as the quarter went on, where it was down about 8%. By March, it was closer to down 6%. So the worst of it was early. Trend inside the quarter pointed up, not down. There is a value menu push, turnaround plan, and the company kept its full-year forecast. Those are real. The decline is real too. Both things are true at once. So the honest read isn't that Wendy's is dying, it's sharper than that. Now strip it all back, and it's one sentence. Wendy's made more money while serving fewer people, then blamed the weather for the pot it couldn't paper over. The number to watch next quarter isn't the top line, it's the royalty line and the traffic count. If people keep not showing up, no amount of bought stores fixes that. And watch whether traffic turns actually positive, not just less negative. That's the line between a real recovery and a slow bleed dressed up as growth. So 2 ways to see this. 1. It's a normal turnaround. The value menu is working, traffic comes back, and buying stores cheap now is smart. 2. It's financial engineering papering over customers walking away, and that catches up. Which one are you? If you want the line by line on every number here, the actual filings, the exact figures, the pages, that's Footnote brief. Link in the description and pinned comment. It's free.